Today, we're going to provide an update on the economy and stock market. We'll then recommend one stock to buy right now and, finally, answer any questions you may have. Please note that this presentation will be available on our website, www.valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at ValueLine. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the ValueLine Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by ValueLine's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, ValueLine has no investment banking business with any company, including all the equities under our coverage. ValueLine does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com or you can call 1-800-ValueLine. Now, let's take a moment to discuss the economy and stock market. This content was prepared by ValueLine's economic staff. The nation's economy has been flashing mixed signals lately. According to the advanced estimate, gross domestic product, or GDP, rose at an annualized rate of 2.8% in the second quarter, dramatically higher than anticipated and far better than the lackluster 1.4% figure logged in the first quarter. In contrast, the labor market has displayed signs of softening, with the July employment report showing just 114,000 jobs added to the economy and the unemployment rate rising to 4.3%. Year-to-date job growth has also been revised lower. Recent manufacturing and consumer confidence readings have also been somewhat uneven. Meanwhile, the Federal Reserve will probably take action as inflation continues to ease. Specifically, the July Consumer Price Index, or CPI, and the core CPI, which excludes the more volatile food and energy components, both rose by 0.2%, matching the consensus forecast. On a 12-month basis, the CPI and core CPI readings showed a moderation in price growth last month, with the headline figures rising 2.9% and 3.2% respectively. This report also came on the heels of a more benign July reading on producer price growth. Ongoing progress on the inflation front and signs of a cooling economy should prompt the Federal Reserve, which is currently holding its Jackson Hole Economic Policy Symposium to reduce interest rates in September. Corporate profits have proven supportive. Second quarter earnings season is in its final stages. With more than 90% of the corporations in the S&P 500 index having reported, the large majority delivered impressive results, with earnings advancing above 10% on average for the quarter. However, investors have been paying close attention to guidance and reacting wherever valuations have seemed extreme. Volatility has returned to Wall Street. Equities softened in late July and dropped dramatically during the first week of August. The pullback was sparked by concerns about excessive corporate spending on artificial intelligence and worries about the economy. In addition, The selling and the level of volatility accelerated when large hedge funds were forced to liquidate U.S. equity positions in response to currency movements taking place in Japan. Whatever the reason, the market logged outsized gains in the first half of 2024, and some profit-taking was inevitable. In conclusion, in the current environment, we recommend subscribers maintain a portfolio of high-quality equities along with an ample cash position. Please refer to the inside back cover of Selection and Opinion in the ValueLine Investment Survey for our statistically based asset allocation model's current reading. On that note, ValueLine provides comprehensive information and analysis to our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, ValueLine offers a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of ValueLine's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website, which once again is www.valueline.com. I will now show you how to access those supplementary reports. Once signed in on the website, head to the dashboard where I'm already located. This is the main landing page for subscribers. Under the Quick Links section, you'll click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stocks to improve liquidity over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among other issues. Due to the changing structure of company balance sheets, ValueLine has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those who don't know, financial strength along with price stability, another proprietary ValueLine measure, are the two metrics that are used to calculate a stock's safety rank, which is a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, ValueLine provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Now, let's move on to the one stock to buy right now. For this, we've gone to the screener. ValueLine subscribers have access to 15 preset screens and 50 fields for screening stocks. I should also mention that another 100 or so fields are available, but require a higher level of subscription. If that interests you, please call 1-800-ValueLine. As noted in our economic analysis, recent economic indicators have been mixed, and the market's recently shown some volatility. As such, we'll be looking for well-balanced companies with below average risk and a high likelihood of year-ahead price performance. To start, we're going to look at the market cap in the company data section. Today, we want to look at large established companies. Large cap companies are, in general, a bit less risky than smaller companies, so in the current environment, confining our search to companies with a market capitalization of at least $12 billion makes sense. By applying that first criterion, we've trimmed away our potential candidates down from 5,700 to just 707 candidates. Next, we're going to filter for timeliness, one of our tried and true ranks. Timeliness is a proprietary ValueLine metric that evaluates a stock's projected price performance in the coming 6 to 12 months. It's a straightforward scale from 1 to 5, with 1 being the highest. Today, we want a stock that will outpace the overall market over the short term, so we're looking at stocks ranked 2 or better. By applying that screen, we've trimmed the list down to 187 candidates. Next, we'll filter by safety rank. As discussed, safety measures the total risk of a stock and, like timeliness, is arranged on an easy-to-understand scale from 1 to 5, with 1 being the most conservative issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. They also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which once again is available free of charge from within the investment education section of our website. Today, we're going to focus on stocks with a safety rank of 2 or better. By applying that criteria, we've narrowed our list to 52 candidates. We also ideally want a stock with decent potential returns over the long term. This figure is derived from analyst projections of cash flows, earnings, and terminal valuation over the next 3 to 5 years. For today's selection, we'd like to have an annual potential return of 14% or better. So applying that brings our list down to 27 possibilities. Finally, we're going to look at price appreciation potential over the intermediate term. Today, we're going to be looking at stocks with appreciation potential of at least 15% to the midpoint of the 18-month target price ranges. By applying this final criterion, we cut our list down to 6 candidates. You can make a strong argument for any of our remaining candidates, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now, and after consulting with a number of our senior analysts, we prefer and recommend Adobe Inc., ticker symbol ADBE. Before I click on Adobe, please note that screens can be saved and revisited by utilizing the Create Saved Screen button at the top. Now, let's take a look at our last full-page report. Adobe Inc. is a software company offering a variety of products for the creation and editing of digital documents and images. Some of its most famous offerings include Adobe Photoshop, Adobe Acrobat, and the PDF file format, which is in fact being demonstrated for us with this page right now. As you can see on the page, Adobe meets or exceeds all of our screening criteria. Like other tech issues, the stock dipped slightly in early August, but has already recovered to pre-scare levels, and there are good reasons to believe that this may be the beginning of an upswing. In particular, we'd like to highlight the company's notable potential in the field of generative artificial intelligence through the integration of generative tools into its creative products. It should be noted that Adobe is not simply integrating another party's AI tools into its offerings, but actively developing its own, which is likely to add far more value over the long term. Continued spending on research and development should help Adobe stay at the forefront of the AI space, and its existing library of image content via its stock image offering, Adobe Stock, stands to be a boon as more legal boundaries are drawn around the use of copyrighted content for AI training, forcing other contenders in the AI arena to scramble to obtain training data. Overall, Adobe is well positioned for the year ahead with some AI-related potential over the longer term. It is today's one stock to buy right now. We'll now tackle your questions. Please note that I typically can't answer complex questions about specific stocks on the spot. For that, I recommend a review of our latest reports. The first few questions were submitted prior to this presentation. Now, I'll hand it off to Alan. Take it away, Alan.
Thank you. Thank you, Nate. We have a bunch of interesting questions today. The first one is, what is a stock's beta coefficient? A stock's beta is a measure of its volatility in relation to the overall market, typically represented by a benchmark index such as the S&P 500. Beta indicates how much the stock's price is expected to move in response to market changes. In general, beta of 1 means the stock price is expected to move in line with the broader market. If the beta is less than 1, the stock is more volatile than the market, meaning it tends to rise or fall more than the market does. And if the beta is less than 1, the stock is less volatile than the market, meaning it tends to rise or fall less than the overall market. Thank you.
Um, So I've got a question. Someone's asking, what did I mean about developing AI tools internally being preferable to using them from another party? Won't integrating those external tools still help companies increase efficiency? And yes, in many cases it will, but um, to draw a slightly crude analogy, in a shooting war, the best guy to be is an arms dealer. Um, if um, if you're just integrating an AI tool that someone else has developed, yeah, that will improve baseline efficiency, but you have to keep in mind everyone else will also be trying to do that. And so you're going to be competing still fairly symmetrically. It's something you have to do to keep up, not necessarily something that's going to put you ahead. Whereas if you're the one developing those tools, um, then that's a bit of a different situation. And so long term, we think that the companies that are going to be the most successful with the adoption of AI are the ones that are providing either the physical components and infrastructure needed to run AI, like NVIDIA, or the ones that are actively developing AI-based software tools for others to use. And that second category is the one that Adobe falls into.
Thank you, Nate. Another good question came up. What is a financial strength? And we talk about financial strength and we screen for it many times as well. So that's an excellent question. A company's financial strength is a measure of its overall financial health and ability to withstand economic downturns or adverse conditions. This metric is crucial for investors as it indicates the company's capacity to meet its financial obligations, manage debt, and fund its operations without excessive risk. And there are several components to the financial strength. Obviously, the balance sheet health, the debt levels, underneath that, the subsegment of debt levels, which is the amount of debt relative to equity, better known as the debt to equity ratio, and the company's ability to service this debt, which is called the interest coverage ratio. Also, there's liquidity, which is availability of liquid assets to meet short-term obligations, often measured by ratios such as the current ratio or quick ratio. There's also asset quality, which is the quality and valuation of the company's assets, including cash, receivables, and inventory. Another item under financial strength is the cash flow. There's operating cash flow, which is the cash generated from the company's core business operations, which is crucial for funding day-to-day operations and reinvestment without needing external financing. There's also free cash flow, which is the cash remaining after capital expenditures, indicating how much cash is available for dividends, debt repayment, or reinvestment. There's also profitability. Earning stability is one measure, which is a consistency in generating profits, which reflects the company's ability to maintain earnings over time. There's also the return on equity, which is a measure of how effectively the company uses shareholders' equity to generate profits. There's also the credit ratings provided by agencies, which assess the likelihood of a company defaulting on its debt. Capital structure is another item. This is the mix of debt and equity financing used by the company with a stronger financial structure, typically having a lower proportion of debt. So, in summary, a company with strong financial strength is generally more resilient to economic downturns, can take advantage of growth opportunities, and is less likely to face financial distress. Conversely, a company with weak financial strength might struggle during tough economic times and could be at risk for bankruptcy.
Mhm. Yeah. I've got a question here. How recent is the recent price? So for a printed page like the one that we're seeing, a digital version of here, The recent price is going to be from about a week and a half prior to the press date of the issue, and that lead time is just because we need time to actually print it and ship it. However, I want to point out that on the digital version of a stocks page, the price that's listed there is updated in real time. So the recent price on the website will always be current, and that's included with your ValueLine subscription. So the printed page will be about a week old when you get it. The website always immediate, and that also, and all of the other figures on the website are also being updated, like how that price affects things like appreciation potential, and those numbers are being updated. And then, of course, as we discussed, there are supplementary reports issued if there's a big event or a big price movement.
Okay, thank you, Nate. Another question that came up is how is Adobe's balance sheet, which is also a very good question. Adobe's balance sheet is quite strong, reflecting its robust financial health. As of the most recent data available, Adobe holds significant assets with total assets of about $30 billion. dollars. The company has maintained a solid liquidity position with cash and short-term investments totaling approximately $8 billion, which has seen steady growth over the years. Adobe's liabilities are also well managed with total liabilities at about $15 billion. The company's debt to equity ratio is relatively low at about 22%, indicating a conservative approach to leveraging debt. This ratio, along with a high return on equity of about 33%, suggests that Adobe effectively uses its equity to generate profits. Additionally, Adobe has a current ratio of about 1.16, which demonstrates its ability to cover short-term liabilities with its short-term assets. This solid financial structure is further supported by a debt to EBITDA ratio of 0.77, indicating low leverage and strong earnings relative to its debt obligations. Overall, Adobe's balance sheet showcases some strong financial resilience, making it well positioned to handle future growth opportunities and potential economic challenges. Thanks.
Mhm. All right. I think that's our questions for today.